Okay, so what if I told you that one of the most compelling financial forecasts for 2026, it wasn't cooked up in a Wall Street lab with supercomputers? What if I told you it came from a farmer, an Ohio farmer, back in 1875? Today we're diving into a historical cycle that has this really eerie track record of nailing market booms and busts. And right now, its next big signal is flashing, and it's pointing straight at our immediate future. Let's get into it.
I mean, it sounds kind of crazy, right? Could a farmer from the 1800s, with zero access to the mountains of data and tech we have today, have actually found a hidden rhythm in the economy? A pattern so consistent that it could still predict market peaks and valleys more than a century later? Well, that is the big question we're going to tackle.
And look, let's just get right to the punchline. That exact roadmap, that old farmer's chart, has its next major signal pointing, you guessed it, directly to the year 2026. It's flagging it as a massive turning point for the markets. So this isn't just some historical curiosity. This is a forecast with a deadline.
So here's how we're going to break this down. First, we'll look at that 2026 warning. Then we got to go back in time, meet the farmer who created this whole thing, and figure out why he did it. After that, we'll dissect the market's hidden rhythm that he claimed to have found. Then we'll pull it all back to today and see how it lines up with our current economic mess. And finally, we'll talk about what this might mean for all you gold and silver stackers out there. You are definitely going to want to stick around for this. All right, let's start with the big one, the prediction itself. This is the piece of the puzzle that's making a lot of very serious people today give this old chart a hard second look. This really is the perfect way to frame this whole story. It's just a fantastic reminder that sometimes the best insights don't come from fancy algorithms or suits in a skyscraper. They come from quiet, long-term observation of how things actually work.
So to really get the Benner cycle, you have to understand the guy behind it. I mean, this wasn't some abstract theory from a university. No, this was a tool born from the fire of complete financial ruin. It's a story about one man's search for some kind of order in all the chaos.
So, the man behind the chart was Samuel Benner. And this part is really crucial to remember. He was not a banker. He wasn't an economist. He had absolutely no formal training in finance. He was a successful farmer whose entire life got turned completely upside down by the markets.
Picture this. It's 1873. The infamous Panic of 1873 is tearing through the economy, and Samuel Benner loses everything. He gets completely wiped out. But instead of just giving up, he gets obsessed with one question. Why? Why do these booms and busts happen? He just pours himself into commodity price data, looking for a pattern, a signal in all that noise. And just 2 years later, in 1875, he publishes his findings in a book with the very chart that would make him a quiet legend.
Now, the key to his entire system was one single commodity: pig iron. Yeah, sounds weird to us today, right? But back in the 19th century, pig iron was the absolute lifeblood of the economy. Seriously, think of it like the crude oil of its time. It was the raw material for everything driving the Industrial Revolution. We're talking railroads, machinery, bridges, entire cities. Benner's big insight was realizing that the price of pig iron was a leading indicator for the entire economy. If you could track its cycles, he figured, you could predict everything else.
Okay, so let's get into the cycle itself. Because after digging through decades of data, Benner was convinced he hadn't just found random noise. He believed he had discovered a predictable, almost musical rhythm to the markets.
And this is it, the core of his theory. He saw that market tops, the years with high prices, the best times to sell, they seem to follow this repeating 8, then 9, then 10-year pattern. But then on the flip side, market bottoms, the years of low prices, panic, the best times to buy, they follow their own distinct pattern, 11, then 9, then 7 years. It's this dual rhythm, this predictable beat that underpins his entire forecast.
Now look, it's really easy to be skeptical of a 150-year-old chart. I get it. But the Benner cycle has a track record that just makes you stop and pay attention. Its ability to call major market turning points is, well, it's spooky. There's really no better word for it. I mean, it's one thing for a theory to work looking backwards, but it's something else entirely for it to keep on working decade after decade.
And you don't even have to dig deep into the history books. Just in our lifetimes, this simple chart pointed right to the 2007 market peak, just before the global financial crisis hit. It flagged the sudden crash we saw in 2020, and most recently, it called 2023 as a major market bottom.
Okay, so this is the critical point. That last predicted event, the 2023 bottom, it happened. It's in the rearview mirror. And according to the logic of the cycle, that event basically fired the starting gun.
It kicked off the next phase and put us on a direct path toward the next major peak.
So this is where it gets really interesting. This is where the historical pattern crashes head-on into the present day. We're about to see how this old farmer's forecast seems to be lining up with some very powerful and honestly some very concerning trends in our modern economy.
So here it is, the big one. Following its 8, 9, 10-year rhythm for peaks, the cycle projects late 2026 as the next major top for the market. It's flagged as the time to sell, to take profits, and to get ready for a big shift in the weather. And Benner's chart is incredibly clear about this. The period we're in right now, through 2026, falls right into what he called good times. This is a period to make money and to save money. But the cycle is set to flip into a period he bluntly called hard times, starting in 2027. And you know what makes people sit up and listen isn't just the chart, it's the economic backdrop we're living in. A great way to describe it is this kind of stagflation light. We've got this really uncomfortable mix of sluggish, kind of meh growth paired with inflation that just refuses to go away. It's a real headache.
And if you look ahead to 2026, the exact year the cycle is pointing at, what do the experts see? Well, they're forecasting pretty modest U.S. growth, around 2.2%. That's not a recession, sure, but it's not a boom either. And at the same exact time, almost everyone expects inflation to stay stubbornly above that 2% target.
But beyond the slow growth and sticky inflation, there is a much, much bigger problem. A massive structural weight that's pressing down on the entire system. And it's a problem that is getting bigger and more dangerous by the day.
Yep, that's the elephant in the room, the U.S. national debt. At $38.4 trillion and climbing, the number is so big it almost loses all meaning. But it has very, very real consequences. Think about it this way. That's over $114,000 for every single person in the country. It's a ticking time bomb, and the Benner cycle might just be telling us when it's set to go off. And those consequences are here right now. For fiscal year 2025, for the first time ever, the annual interest payments, just the interest on that debt, have blown past $1 trillion. $1 trillion a year that isn't building roads or funding research, but just paying the bill on past borrowing. That is a massive anchor dragging on the economy. Now check this out. To really get the scale of that number, look at this comparison. The cost just to service our national debt is now more than the entire U.S. budget for national defense. I mean, let that sink in. This is a massive, historic shift. It tells us we are in a completely new and much more dangerous financial territory. So you can see where this is all headed, right? That 2026 peak, predicted by a farmer's old chart, could be the moment the music stops. It could be the catalyst where the market finally wakes up and is forced to deal with the unsustainable path we're on. All right, so that brings us to the big practical question. If this cycle is really mapping out our future, what does it mean for precious metals? If hard times are really coming, what happens to gold and silver? Okay, first, it's really important to remember these two metals have different jobs. Gold is the classic safe haven, right? It's the ultimate store of value when things get chaotic, and right now, it's being driven by huge buying from central banks. Silver is different. It's more volatile, and it has this split personality. It's part money, and it's part critical industrial commodity.
You know, the so-called smart money is already making its move in the gold. Big banks are putting out forecasts of $4,000 to $5,000 an ounce by 2026. Now, if the Benner cycle is right and we get a major market peak that year, you could see a massive stampede into safety. Investors could start dumping stocks and rushing to the historical security of gold, pushing prices way higher as confidence in everything else just evaporates.
But silver's story has a fascinating twist. While an initial panic could absolutely send it soaring with gold, there's a unique risk you have to understand, a potential Achilles heel that's tied to its very nature.
And this lays it out perfectly. The very thing that makes silver so valuable right now, the fact that it's essential for solar panels, EVs, and all our electronics, that could become its greatest weakness. If the hard times after 2027 turn into a serious recession, that industrial demand could get crushed. And that could cause silver to lose steam way faster than gold, which has almost no industrial demand to worry about.
So let's just put all the pieces together here. On one hand, you have this old, surprisingly accurate cycle, a hidden rhythm in the market, and it's pointing directly to a huge moment in late 2026.
And on the other hand, you have that historical pattern lining up perfectly with the reality of today. A fragile economy, struggling with stagflation, and buried under a truly historic mountain of debt. The timing, it's just remarkable.
So there you have it, a 150-year-old chart from a farmer with a spooky track record, pointing to a major market peak in 2026, right as our economy is staring down a perfect storm of debt and inflation. Is it just a coincidence? Maybe, but what if it isn't? What if the farmer's chart is right again? The only real question is, are you prepared for what comes next?